Have you ever wondered if it's possible to pay little to no federal taxes on a high income in retirement? For many people, that sounds just too good to be true. Well, I'm here to tell you, not only is it real, I've helped clients make it happen. Today, I'm going to walk you through exactly how a couple, Scott and Christine, both 65, recently retired, spending $92,000 a year, are paying minimal federal income tax. If you're new here, my name is David Millington. I'm a certified financial planner and president of Puzzle Wealth Solutions. I've been recognized by Forbes as a best in state wealth advisor and ranked number 56 nationally by Advisor Hub. But more importantly, for over 2 decades, I've helped people just like you retire smart, be tax efficient, and confident. If that sounds good to you, please take 2 seconds to like and subscribe. It really helps more people discover tax strategies like this. All right, let's dive into Scott and Christine's plan. Let's meet Scott and Christine. They're both 65, recently retired. They want to enjoy their golden years. They've saved $1.7 million, and it's broken down like this: $150,000 in savings, $250,000 in brokerage accounts, $650,000 in Scott's IRA, $450,000 in Christine's IRA, and $100,000 combined in Roths. They also get $5,000 a month in Social Security, which is $60,000 a year. Their goal is to spend $92,000 annually, pay as little taxes as possible. And here's how we made that happen. Step 1, you want to manage the provisional income. Social Security taxation is based on something called provisional income. That includes half your Social Security plus taxable income plus tax-exempt interest. For married couples filing jointly, this is how it breaks down. Below $32,000, there's no Social Security benefits taxed. $32,000 to $44,000, 50% of the benefits are taxed, and above $44,000, up to 85% are taxed. Scott and Christine kept their provisional income under the threshold to avoid taxation on most of their Social Security. And quick fun fact, even muni bond interest, tax-free normally, still counts towards provisional income. So you want to watch that carefully too. Step number 2, look at tax efficient withdrawals from the brokerage account. They withdraw $22,000 from their brokerage account. Only part of that is taxable in the form of capital gains. In their case, $11,000 was long-term capital gains. And because their taxable income total was $89,000 for 2024, they qualified for 0% capital gains taxes. Step 3, strategic IRA withdrawals. The last $10,000 they needed, we just used a small calculated IRA withdrawal. So combine that with their capital gains, their total taxable income still stayed under the standard deduction of $30,000 for a married couple age 65 or older. That means, again, no federal income tax on that money. At Puzzle Wealth, we call this the art of staying under the radar. But here's the reality for most of my clients, and I want to pause here for a second. Scott and Christine's situation is great for teaching these strategies, but my typical clients have over $3 million invested with me. In those cases, it's not always possible to eliminate federal taxes altogether. But that said, we are proactive about it every year. In Q3 or Q4 of every year, we conduct a full tax strategy review using Holistiplan, a powerful tax planning software. We look at current year opportunities to reduce taxes, but also look at long-term planning strategies like Roth conversions, timing withdrawals, charitable giving, and more. And sometimes, yes, we actually recommend paying more taxes today to get a much bigger benefit down the road. Once we identify those strategies, we coordinate with your CPA to confirm the plan and make sure everything is aligned. That collaboration is what makes Puzzle Wealth different. We don't guess, and we don't go at it alone. So what are some conventional strategies that might fall short? Because most people do it backwards. They may spend down cash in brokerage accounts first, delay all IRA withdrawals, and save IRAs for last. Seems logical, right? But it backfires, and sometimes big time. Because when RMDs, or required minimum distributions, hit at age 73, they're pulling sizable chunks out of your IRA, which drives up taxable income, pushes your Social Security into the tax column, and can even trigger higher Medicare premiums. We've seen people pay tens of thousands or more because of poor sequencing of withdrawals. So the optimized withdrawal strategy, Scott and Christine used that to take a better path. They started with blended withdrawals now, took small IRA distributions early to reduce future RMDs, and they preserved those critical Roth IRAs for flexibility later. This smoothed out their income and avoided tax spikes later in life. Based on our projections, they'll save over $110,000 in lifetime taxes compared to the conventional approach, which covers some of our fees, right? So that's money they can spend now on travel, grandkids, finally building that golf simulator in the garage. So here's a recap of this strategy we use. They make $92,000 of income work tax efficiently. $60,000 from Social Security, $22,000 from brokerage, where only half of that is taxable, $10,000 from RIAs, all under the standard deduction. That combination equals low taxes, smooth income, and more flexibility. Your next step is, if you're nearing retirement and want to keep more of what you've worked hard to save, now is the time to act. Click the link in the description to schedule a no-cost Zoom meeting with me and my team. We'll walk you through your specific numbers and build a custom plan for you, just like we did for Scott and Christine. Now, please don't forget to like, subscribe, and share this with someone who thinks paying zero federal tax in retirement is probably not possible. I'm David Millington with Puzzle Wealth. I really look forward to seeing you in the next video and greatly appreciate your support.